Hey guys, it's Kyrill with Centerfin Capital, and this is our collective weekly for the week ending April 26, 2024. First, we'll discuss GDP, which is the first reading on how the economy is doing in the first quarter of this year. Came in lighter than expected, and we'll go through the numbers and what our views are on that. Secondly, related to that, we'll discuss inflation. This has obviously been a very hot topic, and we got another reading of inflation for the last month. We'll discuss what that means for the markets and the economy. And then last but not least, we had a lot of the S&P 500, 30% of the S&P 500 reported earnings this week, and we'll discuss some highlights around that as well. Starting with GDP. GDP came in at 1.6. We were expecting 2.2, obviously a lot lighter than expected. Lots of folks started to throw around a stagflation argument. Stagflation is effectively when there's a recession and there's inflation. It doesn't seem like that's in the cards right now, and it's too soon to tell. But we did see a deceleration of the growth of the economy. Q4 of last year, GDP was at 3.4%. This came in at 2.2%. Obviously, the growth in the economy is slowing. Now, there will be revisions for the next 2 months. This is an early number, something to keep in mind. However, when you look under the surface of the report, you actually see the economy is maybe a little bit stronger than it seems, with inflation higher than it was in the prior quarter. If you look at the current dollar GDP, which is GDP not adjusted for inflation, it came in about 4.8%. Last quarter, that was at 5.1%. But inflation was at 3.7% this quarter in this GDP report, which was a lot higher than it was in Q4 of 2023. The GDP number is inflation adjusted. It's a real number. Inflation was higher in the first quarter of this year than it was in the fourth quarter of last year. Real growth was a little bit lower, but underneath the surface, it looks like the consumer, which is 70% economy, is still fairly healthy in spending, although savings are coming down. Disposable income and personal income were all higher and accelerated over the prior quarter. Those are healthy signs. Lots of talk about the stagflation scenario after this report. It doesn't seem to us like that is what we're seeing just yet. It's too soon to tell. Definitely a slight slowdown in the strength of the economy. Based on that, the market's initial reaction, stocks were significantly lower and bond yields on the long end traded significantly higher. Both of those trends reversed after we had some good earnings post the close on Thursday, and bond yields came in a little bit from their highs. Definitely not a terrible report, but was lower than expectations and something to keep in mind. Related to that, we had our first read on PCE inflation, which is the Fed's preferred inflation reading for March, and that came in also a little bit higher than expected. Core PCE came in about 2.8 year over year, which was expected at 2.7. The actual number is not that important. What's important is the trend. The trend is a little bit more troubling. If you look at the 3-month annualized trend, that came in at about 4.4%, including this month. It's trending higher. That's definitely not a good thing. On the bright side, we did see, similar to the GDP report, personal income, spending, and disposable income all came in higher than expected. Savings rates declined. So it looks like the consumer is still spending, powering the economy, but maybe at the cost of savings. That's definitely something to keep an eye on. The market reaction to both the GDP and the inflation report has been, as we've discussed before, we're not expecting as many rate cuts as we were expecting at the beginning of this year. The market's currently pricing in only about 2 cuts before the end of the year, and really a 50-50 shot of a rate cut in the September meetings. Very low probability of a cut in May, June, July, and potentially the first cut in September. And obviously we're getting close to the election there, so lots of things will happen between now and then. The market, as we mentioned on the GDP print, the most troubling thing that happened was the 10-year bond yield rose about 4.7%. It was the first time it was there since September of last year. If you recall, when the 10-year went to 5% at the end of last year, that correlated with a 10% correction in the stock market. Stocks generally don't like long-end bond yields. The long-end bond yield is something the Fed does not control directly. That is really a market-driven interest rate, but it is the interest rate that is used for all sorts of long-term debt. What is it negative for? It's negative for mortgages. Mortgage rates have spiked on the back of this spike in the long-end bond yield. That's obviously negative for housing prices and for housing affordability. Part of the issue with these higher rates is that houses have been harder to buy because they're more expensive at the higher rates. More people have been renting. That's put pressure on rental rates, that's actually inflationary. That's a big part of the inflation calculation. It's also really negative for the U.S. government, obviously, because the U.S. government has to finance a massive deficit. As we've said, with bond yields higher, the U.S. government typically finances its spending with a mix of short-term debt and long-term debt. They've been using a lot more short-term debt, as we've discussed in the past, because the rates on the long-term debt have been significantly higher than they have been. Our spending on just interest for our debt is getting out of control. This is really just bad for the consumer, and it's really bad for the federal government. On a bright note, we had earnings. As we mentioned, we had about 30% of the S&P 500 companies reporting earnings this week. 4 of the Mag 7, so we saw Tesla, Microsoft, Google, and Meta reporting this week. Out of 3 of those, Microsoft, Google, and Meta, what we saw was a very clear trend of capital expenditures, CapEx, as it's referred to, being significantly higher than it has in the past and accelerating, and guidance has been to higher CapEx. And so what does that mean? These companies are all gearing up, as we've discussed, to buy equipment in order to continue to develop AI technology. It's an arms race of sorts. Just to give you a sense of numbers, Meta guided to $30 to $40 billion of CapEx this year. Microsoft spent $14 billion in the last quarter. That's more than a full year of CapEx just 5 years ago. Google reported $12 billion, which was double the prior quarter. CapEx is accelerating. What does that mean downstream? It's obviously bullish for companies like NVIDIA, which has been the front runner in creating the chip technology that these companies need in order to develop this latest generation of AI technology, generative AI. It's also got positive effects on downstream, everything from utilities to energy companies, because we will need a lot of power in order to power these data centers that are going to hold these chips. What it's negative for on the margin is consulting companies have reported disappointing earnings, because a lot of this technology could be used to effectively get rid of some of the work that consulting firms do, and certain SaaS companies as well. Some of this technology could be built in-house instead of having to outsource to a SaaS company. The bears will argue that there is no sense of what the ROIC is yet on this, the return on investment capital yet is on all of the spending. However, for the time being, it is, like we said, an arms race of sorts. These companies will continue to invest in the technology they need in order to develop these generative AI models. We don't see that abating anytime soon unless something changes. That's a trend that we think will remain in place. So that's it for this week. As always, let us know if you have any questions, if you want us to discuss any other topics, future weeklies, and have a great weekend.